This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 53. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management in a new, different Patagucci jacket today. And of course, Rich Diaz, Acorn Macro Consulting. Tom Brady of Macro. Welcome back to the show, gentlemen. What's new? Rich?
I got nothing. Nothing's new. Same old, same old. Liz Truss met the newly minted King of England. And I don't know if you've seen that online. He was just like, oh boy. And he said something underneath his breath was not meant for public consumption. And something along the lines of like, oh, back already, in the most snide, British, underhanded way you could possibly do. Only the King of England could lay that kind of a smackdown, and it was delicious. So that's all I got to report. Otherwise, same old, same old. What about you, Keith?
I did not see that, Keith.
Oh boy, but I want to hear your British accent. When is it going to kick in? How long does it take?
Top of the morning to you. No, I got nothing.
Oh boy,
save that one for the live event after a couple drinks.
Yeah, that'll be fun. So my mom is visiting this week, so it's pretty good so far.
Holy crap, she's got to be in like 200, going on 200.
She's pretty spry for that. Centuries, and we played bingo. We watched Another World, some fish and chips. It's been a great week so far.
That's amazing.
Yeah.
Well, I don't know if you guys saw the news there on our good friends at ArriveCan. A good way to crack off the podcast, but turns out that the ArriveCan costs $54 million. So there's a lot of public outrage right now across the media channels in Canada. $54 million. So it kind of makes sense now. All those 5-star reviews, hundreds of thousands of them. It's imagine if the Loonie Hour had $54 million. I mean, we'd be way up there.
Great.
We're just this fringe podcast.
54 million. I'd be poor.
Oh man. But anyways, programmers apparently recreated a bunch of massive tech companies that do apps for a living. I guess they recreated the ArriveCan app in 48 hours at a small fraction of the cost. So there's now apparently there's going to be an investigation into where all the taxpayer funds went. So that's quite interesting. So lots happening as we kind of exit out of this post-pandemic world, things coming out about these, the vaccines and the ArriveCan, and we're not going to get into that because it's just not worth it. But very, very interesting to say the least. But I think I'd start things off this week on the interest rate channel, because that sort of continues to be the topic du jour, so to speak. So we've got a push higher in yields, which we're going to get into as we go across the world, as we always do. But just looking domestically here, you've got the Canada 5-year bond yield making new highs, touching 3.6% earlier this week. So we're actually getting some news from some of the big Canadian banks pushing their mortgage rates up by about 20 basis points on their fixed rate mortgages. So your fixed rate mortgages are going up another 20 basis points or so. There's some concerns if you look around the world, what's happening with bond yields that we might not be out of the woodworks just yet in terms of higher fixed rate mortgages. So you could be looking at a fixed rate mortgage in Canada at about 6% come November. You could be looking at a variable rate, depending on what the Bank of Canada does on October 26th. It seems like it's priced in for 50 basis points. Are we going to get 75? Maybe. So that could you could be having a variable and a fixed rate of 6% in Canada on obviously a highly levered household sector. Is going to be very, very fascinating. An interesting note here. One of the things that maybe isn't being talked about as much is the people that are coming up for renewal, right? We talked about this a little bit before, but roughly each year, about 20% of mortgages will turn over and come up for renewal. And so right now, borrowers renewing 5-year fixed rate mortgages today, on average, we'll be seeing monthly payments rise about $100 for every $100,000 originally borrowed. So again, if you had a $500,000 mortgage that's renewing, you should see about a $500 monthly increase in your payments. That's some good stats there from Ben Rabideau of North Cove Advisors. So the interest rate shock will take some time to filter through, but we all are obviously starting to see that, and you'll see that more and more as people come out for renewal on their mortgages over the coming 6 to 12 months. That's it. That's all I got.
Can we at least discuss a little bit about the protests regarding the interest rate hikes, please? I know I don't want to get you in trouble, Steve, but
oh yeah, no, that was
come on, we got to talk about it for 2 minutes.
Yeah, if anyone was following along, there's a group in Surrey, British Columbia, which created a protest or a rally around rising interest payments on their mortgages, basically saying, what about us homeowners? And so the media picked up on it. There was like this big rally and protest, and the media picked up on it. CBC News, I think the Globe and Mail, like it was widely covered. So they were basically out there protesting against all these interest rate hikes. The funny thing about it was, well, I think this is probably like the first of many to come, truthfully. The funny thing about this one was that if you actually look at a lot of the names of people that were attending, because I guess there's like a Facebook group or something, that it turned out to be like predominantly like realtors, mortgage brokers, like people that are already like in the industry. People were there protesting, being like, I own multiple properties and I am getting slaughtered. So people didn't really have a whole lot of sympathy. So that was quite fascinating. And I think the guy that originally had started it, he started on TikTok. He kind of went viral and picked up some steam. I think he was like, correct me if I could be wrong. I think he was a real estate lawyer, and there's like pictures of him on Instagram with like a Bentley in his driveway. It is, yeah, I don't know. It's a tough look.
Oh boy. Well, let's sort of now move into, you talked about, they're not getting any sympathy, but who is getting sympathy now out there right now? Because it's an interesting question, because I think if you go out in any city right now, the restaurants are still full, people are still doing stuff, and it's only, people in the financial market world, not only, but and following this closely, like we're able to see where potentially there's a pretty big roadblock coming up. But obviously, Steve, a lot of people that are exposed to higher rates, they're feeling stress with that now. So, we have to be sympathetic and empathetic depending on which group they're in there. I don't think anyone has shown any sympathy towards the policymakers. So that's on both the Bank of Canada as well as in Ottawa. I think we can. I know Rich and you and I were sharing some data there earlier today about what's happening at the provincial and even the federal level in terms of what's happening with interest expense for people. But Steve, like, what other stories are you hearing out there? And excluding this smaller group, and they are experiencing stress because they are being exposed to higher rates, and where there's no sympathy for them is because it's perceived that they simply leveraged up, so they're benefiting from that. But let's make no mistake about it. There is a pretty big group out there right now across the country that's already experiencing stress, not just from higher rates, but in inflation. I mean, again, like, you go to the grocery store, food prices are through the roof. It's really tough, putting everything together. But what else are you seeing out there, Steve, to make it more real life?
I think the biggest thing I'm seeing, I mean, I guess from a housing front, sellers are digging in their heels, we're seeing a lot of people pulling listings off the market and saying, I'm going to wait till the spring market and hope for better conditions, because the last 20 plus years of housing corrections in this country have been so short-lived. And I think it's almost like an implicit bet that inflation is going to roll over and interest rates are going to come down. Like, that's pretty much what homeowners, I think, are betting on. So yeah, I think it has the probabilities to be a catastrophic error or lack, misjudgment potentially. I mean, they could end up being correct, but I think it really I just think that so much of this depends on rates and if they can hold here, right? I just think, like, I look at mortgage rates 5.5 going to 6, and yeah, housing activity's really slow. But like he said, right, like, people are still in the restaurants and stuff like that. Consumer spending has definitely slowed significantly, but things don't look too bad. And it's like, how much longer though can, like, once these mortgages start renewing and I just think rates at these levels they're just on this level of debt is going to really come home to roost. But I think that's going to take some time.
So I just wanted to just, like, add a little wrinkle. I made fun of those people in British Columbia for protesting, and I think it's important to sort of differentiate between a homeowner, a single proprietor, a single family homeowner, or they own a condo here or there, and a speculator. And I think what the CBC and those people of this world sort of failed to differentiate, which was a lot of the people protesting those higher interest rates were speculators. And that's the rub in capitalism. Sometimes you win and sometimes you lose. And if you overextend yourself and you make bad calls, which we all want to do from time to time, sometimes you get you get a margin call, just like the pension funds in the UK that were using leverage products and were not expecting interest rates to rise, and then had a margin call, just like the example of Orange County in 1994, maybe, who got when interest rates rose, they got an effective margin call. That's what a lot of these speculators, when it comes to property, not just property, long duration assets, whether it's tech, whether it's Bitcoin, whether it's like all these effectively speculative assets that only are viable or only profitable or only realistic or only worth holding when interest rates are extremely, extremely low. As soon as you get a situation where interest rates rise, a lot of these business models crash out. And that's, when I joke, and I'm maybe a bit too spiky on this subject, but the people who do not deserve our sympathy are the people who thought that was going to last forever, whose job it is to make those calls, and who got stuff wrong, just like I've gotten calls wrong and I will do in the future. But when it comes to individual homeowners, whether it's a friend of mine who bought a house in just outside of Halifax and was told by a certain technocrat that interest rates would be flat for a long time, that's where I think my sympathy lies. And so I think it's important that we differentiate where maybe some of the media outlets didn't bother doing that.
Yeah, I'd love to just quickly jump in there. I think that make no mistake, as someone that earns their living in the real estate space, I still wholeheartedly believe that this is the cleansing that we need. It is the cleansing that the Canadian housing market desperately needs. It's just, yeah, unfortunately, there are going to be good people that had well intentions, like you said, like the individual homeowner, young family that felt like they were falling behind and decided to take on a lot of cheap debt at the top of the market that will get hurt by this, and that's unfortunate. But I think I would agree to your point. The people that loaded up and bought 2 pre-sale condos, and they borrowed those pre-sale deposits with their home equity line of credit, tapped into that thing, levered themselves the gilts. I think, yeah, those people, this is a lesson in leverage and speculation, and that is the cleansing I think that we need in this housing market after basically a 30-year bull market. But yeah, I think the long story short is there's going to be collateral damage, and I think it's even for business owners that I feel maybe don't feel like they are directly attached to housing, for example, I think are ultimately going to feel this because this is going to ripple through.
I mean, the next stage for this, or how this may develop, I mean, nothing in the economic world can stand still. It's either accelerating or decelerating. And right now, so like I love American football, and I watch this show on football days called Red Zone Football. You ever see it? But you get to watch all the games at once. It's all popping up. And then you get into the thing they call the witching hour. It's like the last 5 minutes, and there's like 8 games. Things are crazy going on. And you can miss the first 3 quarters of the game, and you're not really missing a lot sometimes. But in the last little bit, that's when it gets a bit scary sometimes. And now we're entering that moment from an economic perspective. So here we are now, we're into October. We're going to start to see September data coming out. A lot of corporate earnings are going to start to be announced this week. So starting on Friday, and today's Thursday, of course, for the recording here. So you're going to start to see whether, that this witching hour is going to take place. And what I mean by that, are we going to start to see both, top-down economic data, monthly as well as quarterly, to suggest that things are slowing down and they could slow further? Or, maybe the worst is behind us. And then that's what the hope is. And as you know, hope is never a great strategy sometimes. But, the best scenario right now is that, maybe the gully is happening right now, and we do start to flatten up, and then things will sort of improve, as we get into, November and December. And that will make things easier for all of us. But if it starts to roll over, and right now, the probability on our books is that it's a lot higher that we are going to roll over. But now because we've been talking with this now for a few months, but now it's here, it's game day. It's, 5 or 6 minutes left. The 49ers are winning as normal, of course, and we'll see where we go. Yeah, handsome Jimmy G. Mrs. Icecap loves Jimmy G, by the way.
Man, no red-blooded woman wouldn't love Jimmy G.
I know. She has permission to leave me for one person.
He's a handsome bloke.
Well, I get free tickets, of course, right? If that happened, that'd be good. But again, the point is, we're now at that stage, though, in the economic cycle with data. We had the CPI, the American CPI data came out this morning. Some of the European data as well came out, so we can jump into that next, maybe. But hey, over the next few weeks, we're going to find out, whether are we going to pull it over the finish line or not.
Yeah, let's walk through that U.S. CPI data because it came in hotter than expected. Like I said, I think the markets, we talked about it earlier, homeowners in Canada placing an implicit bet that, inflation will probably be temporary and rates will roll over and everything will be okay. We had some more U.S. data, which everybody's been waiting on. Inflation rose 8.2% on a year-over-year basis. More importantly, core inflation rising more than expected. So I think the economists market expectations were for a lower inflation print, and we actually got surprised the upside. So I mean, Rich, I don't know, Keith, if either of you guys want to sort of walk through it. I'm sure you guys took a closer look at it, but I think that ultimately, for those that were betting on sort of the Fed pivot, this data does not support that. But I'll let you guys sort of jump into it.
So for me, there's only just like one thing that, we've gotten a lot of things wrong on this podcast. We've definitely got the following thing right, and it's the darn shelter component, which, like in Canada, is a lion's share of that CPI, and it continues to ratchet higher. And something we've been talking about, I guess it seems a bit boring to like reiterate it now. I think we've probably been talking about it for a good 6 months. And the shelter component, which is 41.6%. I'm looking at the chart now. That's how I know it. Is 41.6% of the core CPI basket ratcheted even higher. So shelters 6.6, 41.6, which means it contributed to core inflation at 2.7. Easy maths. And that is going to be very, very sticky. So although you saw the headline number sort of continue to not necessarily get weaker, but stop rising, it's that core number that I just think is really, really tough. And I think will continue. That shelter component, which is contributing to the core, it won't stop rising. The other thing we've discussed also is sort of the breadth and depth of CPI. How do you see like the central tendency of inflation? Is it going up or is it going down? We've discussed trimmed mean CPI from the Cleveland Fed. We've discussed median CPI. We've discussed a bunch of others ones. There's in Canada, we have different 3 preferred measures of core. In the US, the one I like to look at is median CPI from the Cleveland Fed. And again, it continues to rise. And so that means, so even though, I disagreed with the two of you before we got onto the pod, I actually thought the inflation print was actually quote unquote good, meaning we're starting to get a little bit of softening in some key areas, food maybe. I have to admit that some of the breadth measures and the most important one, shelter, went in the quote unquote wrong direction. So for a more hawkish Fed, a Fed that's going to be more committed to fighting inflation.
So what I loved about it is, markets are looking, okay, what happened last month? What's this month? And what was it relative to expectations? So on the month over month data now, not only was it a lot stronger than last month, but it was greater than estimates as well. So again, that gives the Federal Reserve, this ongoing commitment that they can continue raising rates is what they don't want to happen in the financial market world, of course. And then at the same time, we keep talking about, hey, the economy is slowing, and it was slowing. And all of a sudden, one of the GDP estimates that everyone loves to use these days is from the Atlanta Fed. And it's called the GDP Now forecast, something like that. And all of a sudden that spiked higher in the last week of September. So not only are we in a period where all of a sudden, inflation is still sticky, it's still strong, we could potentially have a stronger economic data point coming out for GDP by the Americans in Q3. And that's like the deathbed if you're betting on, the Fed stopping to raise rates. So they're not there yet, guys. Like they're going to continue to raise rates unless there's the financial accident. And you want to go through the financial accidents that we had?
Before we, if I may, before we go into that, I just wanted to just talk about just one thing, which relates to the inflation, which is the inflation expectations are starting to roll over. And so there's Keith, but there's just like two separate things. There's one, which is the CPI basket, consumer price index, which is like what you're buying, how much you're buying of, what are those prices doing? And then there's inflation expectations. And these include break-even inflation expectations, which are market priced bonds, or consumer inflation expectations from the University of Michigan or the Conference Board, or there's inflation-linked swaps, which are, again, another bond instrument, but it basically tells you what's going on in the inflation picture or what the market's pricing out. or there's the Citigroup. Citigroup is a bank, I guess, and they have an inflation surprise index, which compares what inflation is versus the expectations of the market. On all of those measures, break evens, consumer inflation expectations, inflation like swapped, and Citigroup inflation surprise index, all of them have rolled over, including, by the way, the ISM prices paid. So it's actually sort of fascinating that while the Fed gets more and more concerned with inflation, which I agree with you, Keith, is what they will do probably, a lot of the measures, like I've named 6 or 5 or whatever, are actually rolling over. And so I think it's important that we I know that muddles the picture. It makes it more complicated, but it's important to just keep that as like something in the back of your mind. Inflation expectations across the board are actually rolling over. Sorry, Keith, you go.
Yeah, and that's interesting. And of course, we need to talk about interesting things in a minute. Oh, are we going to have this? Are we going to add the soundtrack, Steve? Are we planning to do
you're
that?
so mean.
We're not. Well,
I thought we were supposed to have someone suggested we have a zinger board for you, like a
zinger board.
What is it called? Those
every time. No, what are those?
We need a kazoo.
No, the things that laugh in the background when someone makes a
laugh
joke.
Track.
The laugh track.
Whatever. Yeah.
All righty then. But carrying on with that. So what now? So that the big zinger these days, the big laugh track is that everyone is calling for this pivot, and it's very easy to come up with the reasons why it's going to come down. And as Rich pointed out, like a lot of these data points are suggesting data is going to roll over, especially the year-on-year data. Like it's just a mathematical fact. It's just the way the numbers work out, right? But it doesn't mean your price of bread is going to, it went from what, $2 to $5, and now it's going to go back down to 2 again. That ain't going to happen. It's just going to stay at $5. I don't buy bread, guys, so I don't know the real price of bread. I apologize.
Gluten-free.
I'm gluten-free.
Gluten-free, yeah.
Gluten-free millennials.
Yeah, I like my pizza, and there's lots of gluten in my.
I eat my avocados with a spoon.
Yeah, but with your pizza dough, you want to see the glutens. You need that forming. That's where you get good strength with your dough.
Extra gluten. Mrs. Ice Cap.
You need to let your dough rest for a solid 30 minutes after making it before you do other stuff with it. But back to less important things here. What we're looking at is that everyone continues to call this pivot, because if you get the pivot call right from an investment perspective, man, it's a lot of money to be made. Like it's going to be really cool if you're able to do it right. But however, that's what the Fed, they continue to come out and they say, hey, everyone trying to call a pivot here? We ain't going to pivot. We're going to tell you when we're going to pivot, because in the past, we've always told the Fed or the Bank of Canada or the ECB when they should pivot. But there's this real battle taking place right now. And, the Fed, they are committed to continuing to raise rates. And as we like to say, until something breaks. So we need one of those. I think the central banks should have one of those signs up there, like 53 days without an accident. I think right now.
Yeah, we do.
Yeah, they should. And I think right now they should have it by the hour, like 3 hours without an accident, something like that. But like even this week.
We're going to get into that, by the way, because that's there's a lot happening behind the scenes. But Keith, continue.
Should I get into it now? That's where I was going to.
Well, no, I was going to ask you guys quickly, just anecdotally. Like, I know that the Fed is like data dependent, and fair enough.
Cough.
Yeah, but do you guys feel like anecdotally? I'm genuinely curious. I'm sure we'll get a lot of comments in the YouTube and whatnot, but do you feel like anecdotally, like prices maybe aren't necessarily coming down, but are they still going up? I don't know. Like. To me, I am seeing a lot of anecdotal things, maybe because I'm predominantly in housing, but like the cost of things to me seems to be coming down.
I love you for saying that, Steve.
Anecdotally.
I love you, Steve. I think it's important to remember that when inflation was really budding, that all of the CPI numbers were lagging, and everyone was like, how can that be? Remember, we were talking about this on Twitter, like, we would post that inflation was 4% or 5%. Everybody's like, that's ridiculous. Inflation's 30%.
Remember, it was
blah,
like
blah,
food.
blah.
They're like, food was up like 3%. Everyone's like, dude, have you been to a grocery store? Like, where are you shopping?
Exactly. And I think that the opposite might be true now, which is to say that the index, which is a slow moving, cumbersome, flawed, but useful measure, continues to ratchet higher. But the anecdotal evidence, I agree with you, Steve, you're starting to see some discounting, some sales, some whatever that's not necessarily being reflected in that index. So the equal and opposite reaction that we saw 2 years ago, whatever. I'm happy you brought that up. I totally agree.
I'm going to take the other side of this. I think right now we're having this, it's a pause, a gully, we like to use that word. I think once we get through the fall here, the opportunity for energy prices to scream higher is going to be here again. And that's important because in
Fair. Yeah, that's a fair
everything
argument.
that's created on this earth, energy contributes, to the final product coming out. We're also going to have food prices are still screaming higher. We're getting into the winter. I don't know, guys. I think.
Hey, but that's a fair argument. That is a fair argument. But then it's like, what the hell is a central bank going to do about an energy supply shortage?
Well, that's just it.
More
then.
renewables, Steve. We need even more renewables. Hashtag sarcasm.
Hey, Greta Thunberg, by the way, Thunberg, she was out promoting nuclear power in Germany. So
there is hope after all. Well, Christina Freeland was just telling everybody that crude oil is a curse. So, there's that. But sorry, I digress. What were you going to say, Keith? Sorry.
So anyway, so the point being is that I think it can start to scream higher. So back to like, if we're the central banks and, Steve says, I don't know how to make any more energy, and Rich says, well, it's easy. We just change policy towards this, and that, but it's still going to take years to get that turned around here. So the only immediate thing that, we can do to try to reduce inflation is to literally, crush the economy again. As some guys say, some folks will get hurt, and they don't care about the folks. They just want to get this brought down. Of course, we now have the newest Nobel Prize for economics winner, quite close to the Americans. So Ben Bernanke, if you guys saw that news. Yeah, Ben was just awarded. So he's, he'll go down in history, the guy that was driving the car and didn't see any of the potholes or turn on his wipers. No,
I'm going to defend Ben. I cannot believe I'm doing this, but I'm defending Ben Bernanke.
Oh, buddy, you're going to get roasted in the YouTube.
No, I'm going to do this.
You're going to get skewered.
I don't care. The mistake
skewered,
is not
roasted. Would they turn him slowly, Steve, around the pit, or would it be like
2008
a fast one to make him
was
dizzy?
A depression. There was genuine deflation. You needed to do quantitative easing. Ben Bernanke is famous and did his PhD in the Great Depression. And the mistake that the central bankers did in the Great Depression was raising interest rates and not providing sufficient liquidity for the banking system, which compounded the destruction of assets.
Fair enough. I think
the mistake, wait, let me just finish really quickly. The mistake was using that exact playbook, the same hammer, for today's nail. He was not the central banker. And so as much as central bank, Ben Bernanke has shitloads of problems with him, I'm sure he has all kinds of moral failings. But the criticism he's getting this week for the Nobel Prize, I think, is wrong. Sorry, Steve.
Yeah, okay. I mean, that's fair. I mean, you were going to enter a depression. Fair enough.
Cue the onslaught of YouTube comments.
Once again, I'm going to add some sanity back.
Keith, the problem was
to the room.
The problem was they engaged in QE for like a decade after.
Right. I agree with you. But in the initial stages, it was the right thing to do. Anyways, we're getting sidetracked.
Well, because actually though, it's very important. It's a very important conversation because it ties into today. There's so many parallels with it. What's happening here? So my comment on the Bernanke is that, when I comment, he's driving on the road without the wipers going and stuff, drinking his pina colada and all that stuff, and listening to Huey Lewis in the news as you would, right? Because it's fun stuff. he was the guy that was asleep at the wheel that allowed the housing market to do all these, wonderful things back then. So you have that, of course, right? However, if you go back to, Rich, you made a good point. You got to save the world and everything, because that's their mandate, and that's what they would do. And I'm sure we would have done the same thing. But Steve made a great point, is that once it was saved, that they should let everything reset again.
Agreed. I agree with that completely.
Yeah, because then all of a sudden, I always talk about price discovery. Right now, like, what is the true price of the Canadian 10-year bond?
Of the JGB.
Yeah, we need to go into that one. Absolutely. So let's use that as an example. So that's the Japanese government bond. So the 10-year JGB, it went, I think, 3 days without
4
trading.
days now.
Oh, 4 days, was it? Okay. So, again, this is probably.
Can you explain that? Can you explain that, especially like to like some of the listeners that are like listening to, like, so the JGB.
Can you explain that to me?
It doesn't trade.
Yeah.
It doesn't trade for 4 years, or 4 days.
Yeah.
Maybe explain sort of the significance of that. For people that obviously aren't bond traders.
People that know me well, like I am a US dollar bull. I think it has the opportunity to surge. It could double from here. And one of the reasons is 2 reasons why it will surge. One is because everything else is so crappy. But the second reason is because of liquidity. Because the US Treasury market is the only market that's big enough in the world to absorb money. So you can put in $1 billion this morning and you can sell it again in the afternoon. And you know what's going to happen to the price in between? Maybe not too much, right? If you have liquidity for any market, it's gold. Like the housing market, there's no liquidity right now. Like what's the true price of, the house on X Street? Like nobody knows, because there's no bid on it. So when we say the Japanese government bond, the 10-year issuance, which is the benchmark, the most widely issued bond in Japan, which has the second largest debt load in the world behind the Americans, if that doesn't trade for 4 days, I mean, that would scare the crap out of you. And of course, it's not going to trade because there's only one buyer. That's the Bank of Japan. And at the same time, they're trying to, they've really put in a soft peg on the yen. So they're trying to hold that still. So the Japanese, they're over there, they're like Bambi, sprawled out on the ice, trying not to have anything crack or break through. But when we go through like earlier, like how many days without a financial accident, man, like Japan, like every morning I'll wake up and I can't wait to see what's happening with the Japanese market. And so that's a big one, Steve, to say, hey, it hasn't traded for 4 days. And but back to, I guess, the original, Bernanke story. And it's always, hindsight is I'm pretty good with hindsight. I usually get it 90% right, but it's the same thing today. If they let the world return to have a proper price discovery, find a true value for something back in 08, 09, you know what, that would have happened. Bond yields would have screamed higher. A lot of banks would have went under and stuff like that. But I can tell you firsthand, for every bank that went under, for every dollar that went under with the bank, there's at least $5 out there in fresh capital that would have rushed in to start up a new bank. So in Canada, let's just say, for example, 5 banks go under. This is what you do. You close the market for 2 weeks and you say, you put up a sign on wherever they want to put it. And they'll say, hey, we have 5 banking licenses available. Please apply. You need to have, at least 100 billion in assets or 50 billion or whatever. You know what? You're going to get like 50 different guys applying for that license. And you start from scratch again and go ahead. You keep going. The challenge, of course, is that all the policymakers are all friends with all the big bankers anyway on the commercial side. If you're with a central bank, your next job is likely with one of the commercial banks. Everyone in Ottawa or DC or London or Tokyo, they're all feeding off the same trough as well. So they just can't let it go under. That's the score that they keep. So then, as you say, Rich, here we go, like 10, 15 years later, and we're now back to the exact same point in time. And 10 years from now, Powell will get his Nobel Prize. I'm sure Yellen's going to get one as well. Oh, Steve, you had to give us Yellen's 2 quotes from one day to the next. Or do you have it, Rich?
Yeah,
well, no, I was just going to say, go for it, Steve.
Okay, so Janet Yellen here. I mean, this is why people have no faith in politicians and policymakers. So Janet Yellen says, U.S. Treasury Secretary Yellen, I'm not seeing anything in markets that causes me to be concerned. The following day, she says, I'm concerned about the loss of adequate liquidity in treasuries. So there you have it.
I mean, what I was going to say is really bringing it full circle to the people in Surrey protesting and relates to the banking sector collapse in 2008. And of course, what's going on now. And it's my next pickup line. It's called moral hazard. And that's what, Keith is, skirting around and dancing around the term that he was, trying to he did a good job articulating it without saying the actual term, which is moral hazard. In economics, it's a term. Moral hazard is a situation where economic actor has an incentive to increase their risk. Think British Columbian housing speculators. So they have an incentive to increase their exposure to risk because they don't never bear the full brunt of their costs. E.g., there's always a bailout. So, I mean, that's very obvious. We've seen hundreds of examples of that. And that's what we've been subject to for the last, 15 years, Keith. Moral hazard. You're a situation where the actors are not appropriately incentivized or rewarded with the risks that they take. E.g., they get their bonus even though they tank the company that they run, or they get bailed out even though they make bad decisions, or they cut interest rates. And Keith is exactly right. This idea that when a company goes bankrupt, those assets just vaporize, they go to money heaven. I don't know. That's not at all how capitalism or any real system works. It's the equity holders that get wiped out normally. The bondholders jockey for position. They distribute the assets, and other people come in and either use the existing manufacturing plant or an intellectual property or whatever it is, and life goes on. And so it's this moral hazard thing that we've been dealing with for a long time. And there you go, Keith. I just taught you something. A new pickup line for Mrs. Icecap.
Wait a second. How do you spell it?
I'm a terrible speller. I can't spell.
I want to sort of jump in next. It ties in with a lot of this, or maybe it don't. I'm just using that to go into it. But again, it's with the bond market. So over in the UK, so their long bond is down about 50%, so 0.5% year to date. And you talk about moral hazards and some folks lost some money and stuff like that. But I think people know by now with the UK bond market going down so much, it's creating a lot of challenges over in the UK. And this is where Rich and Steve would say challenges with some quotes wrapped around it. But it's created this environment that has never before been envisioned. So I want to just share with you a conversation I had about maybe 5 years ago now with the pension fund up in Toronto. And they're in this like 60-40 world, and I said, listen, you guys get the potential here to get completely your bond portfolio is going to get just trucked. And they said, well, what do you mean? I said, well, we can go in this scenario where the bond market could fall 10, 20, 30%, something like that. And they're like, okay, we understand what you're saying. We want to run this by our consultants, because people may not realize this. It's really funny in that, like in the investment world, investment managers, we're licensed. We go all through this stuff, and you have to be licensed, to manage money and stuff like that. When in actual fact, the largest money managers in the world are really the consultants. So like the guys at Deloitte, Mercer's, and guys like that. And they're not licensed as investment managers. Kind of ironic here. But the reason I share this story is because, I tell these guys, you have the probability of having permanent losses in your bond portfolio. And they say, well, it's not going to happen. So they go to the consultants, and, the consultants come back and tell them, which they relay to me. They said, we went through, hundreds of scenarios, with our models, and not once did it ever pop up that we have the probability of having these kinds of losses in our bond portfolio. So therefore, in the end, the conversation just ended. We didn't become friends with the pension fund at the end of the day. And the pension fund today, I'm sure this year they're probably sitting on minus 10 to minus 15% losses. But the scenario I presented to them, it's exactly what's happening in the UK right now. And it comes back to this situation where if all of a sudden there's a sudden rush to sell stuff in your bond market and there's no buyer there, that's when all the bad things start to happen. And that's what the average Canadian is just not aware of right now. So you're sitting in a balance fund. If for some reason the Canadian bond market experiences this sell-off moment in time, after it starts or during the weekend, whenever it is, the Bank of Canada is absolutely going to come out and come to the rescue. That's going to happen. The only question is how much stress is created, before and after the event. And which kind of leads to what, Rich and I, you were sharing some data earlier about the interest burden or the amount that's allocated to interest expense by the federal government and provincial governments in their bond portfolio. And the reason this is related, because, interest rates have gone up so high. And, so what, we found a great report this morning. I think it was the Simon Fraser Institute. Is that one of the big think tanks?
Yeah, it is. People don't seem to like their...
the Fraser Institute, sorry.
Fraser Institute,
well, they're right wing, so...
that's why people don't like them. Got it. Okay.
But okay, so what's some interesting, I think anyone that comes out with data that I can't find elsewhere, it's great. And so the report I found here is based on the 2020-21 fiscal tax years. So it's important because it's before rates started to scream higher, right? And what I wanted to find out is, because what I'm curious about right now is what everyone should be, as homeowners, mortgage owners, credit card owners, stuff like that, we're all exposed to rates going higher. And so, it's going to be curious is, what happens at the federal level and provincial level, how much of our tax revenues are going to be allocated to the interest burden. Because they're like anywhere else. They borrow a lot of money, they have to roll it over and things like that. But prior to the interest rate cycle that we're experiencing right now, these are just some random numbers, and they're going to be lower than what we're currently seeing. But at the federal level, about 7% of our tax revenues coming to Ottawa is used just to pay interest on debt. Right, so 7%. And I'm just going to guess, let's just say the average rate on their borrowings is at 2%. Rich, it might be lower, maybe. I'm not quite sure.
No, I would say that's probably right. You could probably back it out, but that's probably not much higher than that.
So that's like back then for this 2021 study, it's about $20 billion a year. And that's actually greater than the equalization money that's sent out to the provinces, which is just a little bit below 20.
That's a fun fact.
It's incredible. Like a lot of Canadian provinces, they need, those payments from Ottawa, right? To just sort of balance their budgets. Employment insurance premiums that Ottawa is collecting is about 21 billion, right? To give you an idea that the size of this, what's going on. If you look at Ontario as an example, if you look at their interest cost, combine what they're paying, it's actually two of them combined is about 20 billion as well. That's greater than what they're spending on post-secondary education in Ontario. And it's also greater than infrastructure. See how it's moving along here. And like the final one, to give you an idea, like at the national level, interest cost, it's equal to pension benefits. So CPP and QPP. That's Quebec pension plan, I guess, as well as education. So from kindergarten to grade 12. Again, these are all incredible numbers. The province that's in most trouble, so back then it would have been Newfoundland. So about 15%, so 15% of Newfoundland's tax revenues is going to pay interest on their debt. So think about what it's going to be now when they have to roll over all this debt.
Yeah, it's a really good point.
It's going to skyrocket, right?
Yeah. Keith, I mean, we chatted about this. I remember reading one of your ICE cap reports, but people forget that at the onset of the pandemic, right? Like the Bank of Canada come in and start absorbing provincial debt because, basically had gone no bid and the spreads were blowing out. So I think like people, I know in Canada, we get so focused on, am I frozen?
A little bit.
Anyways, people in Canada get so focused on the household debt burden, right? Like the burdens of households. And we just forget about, the federal government, provincial governments, and everybody's sort of in this ride together. Some will fare better than others and whatnot. But there's actually some good data from April of 2021. The federal budget released. If you look at their sort of forecasting, they had the 10-year government bond in Canada in 2022. They said it would be at 1.9%. I believe right now we're about 3.2. So they've missed that. And then in 2023, they said it'd be at about 2.3. So the federal government's own budget sort of forecasting is going to be way off. And so it's really interesting to sort of go back and look at that and sort of see that these rate movements are catching everybody off guard.
Okay, but wait a second. I have to say, although I agree with both of you in the sense that, issuing loads and loads of debt at the short end of the yield curve, which is exactly what Christina Furlan did when the pandemic hit, was not smart at all, because that's where most of the interest rate hikes happened, and you have to roll over that debt. Again, not smart. Your interest burden will definitely increase as a percentage of revenue and percentage of GDP. I will say that nominal GDP growth is a hell of a drug. So what do I mean by that? If your inflation is high, and we've talked about this before, your implicit price deflator, which is the inflation for the whole economy, is high. And in Canada, it's like 8 or 9%. I can't remember. You have a situation where even though you've actually made terrible decisions and inflation's really high and people are suffering, your debt to GDP actually falls. And you say, Rich, how's that possible? Because your inflation, your nominal GDP, so what's nominal GDP? It's real GDP plus some kind of inflation component, increases more than your debt. And so funnily enough, Canada's federal government debt to GDP is down to 42% from a peak of 58%. And so this is why a couple of years ago, central bankers were talking about, we want to target a higher inflation rate. And it's just like, and of course, now everybody's, of course, walking back on that, just like they walked back on MMT, just like they walked back on UBI and a bunch of other stupid things people talk about, renewables. But it is interesting the way that, some inflation is useful, right? Because in effect, you deflate your debt burden. But Keith's point is spot on. I think we're about to see a major inflection point in how much money our governments, not just Canada, by the way, globally, spend on servicing debt. And I think it's going to hurt. It's going to hurt on what we do, infrastructure spending, etc. Sorry.
Do you see politically? I mean, it's going to be interesting. Like, do you foresee this like big pivot of like, we've been in this era of, especially in the last like 5+ years, of just massive federal deficit spending, just to flip back to like now austerity has like become popular. Like, do you guys like foresee that personally? Like, I feel like nobody really wants to go through pain, but I'm like, I also see people like, it's funny. I always like look on like Twitter comments, or I'll go on like Instagram and I'll just read like social media comments, which is never necessarily the greatest barometer of like information, but I always look at it just from like a sentiment perspective. And to me, it feels like people are like, yeah, we got to get this inflation like under control. And like, the government needs to stop spending money. And so it's interesting. Like, I wonder if we actually will get back to this where austerity becomes like a popular political policy.
I'll go on this one. One quick point though before we jump into this. TD Bank, they just issued a 50-year bond at 8.25% interest.
Yeah, I was making some big headlines.
I'd take it.
What? A high ticket, or you want to?
I would take it.
Go buy it, man. Fill your boots. It's out there.
That's,
It's not obvious to me that that's a terrible idea.
So the question is, you don't look at these from an investment perspective. You look at it from a borrowing perspective. You're like always, do the 360 thing. So why the heck is TD borrowing at 50 years at 8%? I don't know. Maybe it offsets something else on their book somewhere. Because remember, guys, banks have some really smart guys and teams working there to help to offset a lot of exposures they have. And we're only aware of like 1% of the exposure. So you can never take something like that in isolation.
You're right.
But the fact is, they did issue a 50-year bond. I think it's 8 1/8%. I think it is. Anyway, just interesting, right? It's just
what is interesting. If one of Canada's largest banks has to pay 8% to get capital,
it's unsecured. So it's an unsecured debt. So if something did happen to the bank, like they're the last ones to line up to get paid, and who knows what they get on it.
How do you foresee a lot of this next couple of weeks and months playing out? I'm actually more particularly curious about your thoughts on England, for example, or the UK. You've got the Bank of England's central bank Bailey there coming out and saying, we are serious, pension funds, you've got 3 days to sort of fix your books here before we withdraw, our QE programs that we had to intervene with. How do you foresee that playing out?
I think England will make it to the quarterfinals and then they'll lose, and Rich won't know what to do with his life.
Penalty shot. They always lose in penalties.
The Germans will beat them, of course. That's the way it'll work out. Steve, to answer your question, I think this risk with the UK situation has been contained right now.
You think? Okay.
Yeah.
Subprime has been contained. Okay.
In the UK, they're putting a backstop on it. The currency is recovering. That the Fed is obviously helping them. And by the way, on the Fed swap lines this week, the Swissy, they borrowed, I think it was $3 billion on the swap line. And people say, well, big deal. I say, yeah, that's for Credit Suisse, right? That's what the money is for. Maybe UBS as well. So what people maybe don't appreciate is that when these big banks run into problems, they need US dollars. That's what they need. And the Swiss National Bank doesn't have US dollars lying around, nor does the the ECB or Bank of Canada. So you have to get US dollars somewhere. You get it from the Fed. And it just happens to be an amount that's very close to what might be needed to help keep the Swiss banks flowing again. As for where we go next, Steve, I continue to think we're on an edge here. And we can flip one way or the other. People hear that, they automatically think it's going to go on the wrong side of it. It's going to be really bad. But again, it could. I mentioned, I think a couple of weeks ago, and even you guys looked at me like, "What the hell are you saying?" I think we could be getting closer to the trough in equities. So maybe it's 20% lower from here or 10. I don't know. But
man, you're gonna get roasted on the YouTube comments now too.
No, yeah. I agree with. I said last week when there was sentiment, remember, and I did get roasted in the comments because my thin skin. I brought myself to the YouTube comments, and then I started crying. But people were just like, "Oh, you're nuts!" It's like, dude, the sentiment indicators, the technical indicators, they're all cratered. You can only sell off so much before there's the capitulation index, which is something I track from a company that I used to work for that I won't plug. It's all already down. Sorry, Keith, you guys go for it.
Yeah, but I'm not saying that like we've reached the bottom yet, right? So don't.
No, I'm not saying that either.
I'm saying that. I'm just saying that we could be getting closer there. But see, like over the next few months, the big risk we have right now, I suggest when the companies start to report Q3 earnings, it's not their earnings they're reporting, it's their guidance. And if I'm running one of these big companies, I'm warning. I'm just going to just get it out there, right? Let's put the bar low. I would be very concerned for the banks, even though they can always prop up numbers one way or the other, but their loan portfolios, I mean, I think
in Canada, you mean?
and the Americans as
No,
well.
no, I don't agree
That's
with that.
gonna. Well, we'll see. We'll see how they come out with. I think Friday the U.S. banks start to come out. So
Larry
we'll
McDonald had a
see
really
those.
Larry McDonald had a really good tweet. He's a great follow on Twitter if you don't follow him. It's at Convert Bond. Anyways, he's the Bear Traps report. Smart guy. So he says, why are things breaking? He goes, let's look at the past rate hiking cycles. So April 2004 lasted until June of 2006. Raised rates by 425 basis points. Took 26 months to do that. And then you had September 2015 to December of 2018, 39 months, raised rates 225 basis points. This year, we've raised 300 basis points in 6 months. And you got $50 trillion more leverage and a low coupon bonds debt in the global system versus 2018. So 50 trillion more leverage. It's pretty staggering when you kind of break the numbers out like that.
Yeah, they're big numbers. They are, and but we see where we go here. I mean, like we come back to, the risk that we know, and we're still waiting them to fall through here. Again, Japan, I don't know how they get out of this. Same with the Chinese. I mean, CNY is deteriorating, every single day. Hong Kong, they continue to spend excess reserves to support the peg. The Italians, at some point, they're going to have to pay Brussels. That's coming up imminently. So we'll see where we shoot through here. But again, the possibility, though, is that, again, if we can get through the UK with their crisis, and I think we have, maybe I'll be wrong, right? Maybe in an hour from now, sterling has gone to zero, but I don't think
so.
That's
Where are you
happen.
most concerned these days? If you're like, okay, maybe the UK maybe they've contained what they needed to contain. You've still got sort of, rumblings about Credit Suisse. You've got what's happening with the Japanese yen and the JGB market. Where do you feel the largest risks are today?
Yeah, so the risk is that, let's just say it's the Italians or the Japanese. One of them, it just pops that they can't hold the ball underwater anymore. And then simultaneously, everything else goes pop, 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 pop. That's what happens. That's what the risk is. When the UK had their problem, the UK went pop, and everything moved a bit. And I'm telling you, like the phone lines are lit up, everyone's chatting. Okay, how do we solve this? And but that's what the risk is. And for anyone who's short, incredibly bearish, the risk that if you're on that side of the ledger is that the policymakers are able to contain it. That's what happens. But think about it though, like either way, we have this huge debt load around the world. No one can tolerate these spiking interest rates. Everyone can adjust to a slow trending move in anything. That's just the way we are. We all adjust to it. Like the sudden spikes is where it'll come up. So that's why, again, for us, I always talk about these fat tail events and everything. And the way to really take advantage of something like this is to make sure you have some kind of exposure on, where if it does happen, you're going to benefit from the US dollar just like surging higher, because that's the outcome behind it.
So I just want to so back to your point, Steve, 2 points ago, which is, I agree, like it's undeniable there's much more leverage in the system. But I think the one important difference that I see versus what happened in 2008 is the cross-border claims. So what do I mean by that? So the Bank of International Settlements, which is the central bank's central bank, has data on what countries owe one another and in what currency. And so what does that mean? So if you have an incredible amount of liabilities and you're country A, or you have assets in country B, and the cross-border claims in another way of saying it is sort of your contagion, or how affected or effected, whatever, you are by a particular country, either spreads going up or inability to pay or cash flow issues or tax policy or whatever it is. And so the global's central bank, the Bank of International Settlements, aka the BIS, aggregates something called cross-border claims. And they do this for banks and they do this for the non-bank sector. And what's really important to note is that 2008, this was 20% of GDP. And if you look at the chart, which we will share, it was a ski slope. It was Mount Everest all the way up from 6% in 1985 all the way to 20% in 2008. Interestingly, now the cross-border claims, so how sensitive certain countries are in aggregate, of course, are to other countries, is at the same as it was in 2000. So it's 12%. And I think that's one of the reasons why, for example, I think the EM has been able to survive thus far. They have lower debt levels and a much, much lower foreign debt exposure than they might have had 10, 15, 20 years ago. And it's just something, when we're looking at what you said, Steve, which is really important, that, $50 trillion of extra exposure, it's also important to know that the cross-border claims, I think, are way, way, way lower. And I think that's an important difference.
Yeah. I mean, I think Keith really, it's a great point. I think Keith also summarized it very, very well, which is to look at the bigger picture with this, like, I think the real bubble is at the sovereign level.
Yeah.
And, we're going to see ballooning interest payments, from all levels of government, and they're struggling to obviously, with this, and we're seeing the ramifications of that. So, and it's like, it's again, in this environment, that's why I was asking you guys earlier about like the flip back to maybe some level of austerity, because it's pretty hard to raise taxes in this kind of environment. It's like drawing blood from a stone, but maybe they can. But tax revenues have to be down, right? How much of your tax revenues are you generating off of, in Canada, that's property sales, residential property transactions, capital gains taxes from those ever inflating houses. And obviously the US, I think that's probably more focused on the stock market every single year, when that goes up 10% a year, right? So yeah, I start to wonder about government tax receipts.
Yeah, it's just one more. I know we're running a bit longer, maybe, but just one quick comment on that. So, if you go back to the austerity days that the Eurozone and the EU, they experienced back in 11 or 12. When was it, Rich? I don't remember.
It was like 12 to 16, basically.
There was no austerity. Instead of, like, for the budgets, instead of increasing their spending by 20%, they increased it by 25%. So then they say we reduce spending by 5%. They still increase spending. So I'm not.
They all ran deficits, is what Keith is trying to say. They all continue to run deficits past their own Maastricht Treaty numbers. Sorry, keep going.
Correct. So I don't think, Steve, we're going to be able to do any austerity, because like, one of the things to add on to what was the risk event here with Canada. The risk event is that if all of a sudden our interest burden starts, increasing exponentially, that gets reflected on the currency side. So just as sterling, went from, where did they go? 130 down to 105, or 120 to 105, whatever the movement was. Like, it's a good 20% drop. I think that same situation can happen with the Canadian dollar. So Canadian dollar right now for, I don't know, a spot for the December contract is it's about 73 cents maybe. We can go down to mid 60s.
Budget,
like
by the way, April 2021.
Rich,
budget ahead like of 80 cents.
Here you go. That better?
We heard you. We heard you the first time.
I know. I like the fonts, right? I like to snap my fingers all the time.
Federal budget in Canada, by the way, had had it at 80 cents into 22 and 23. So take that for what it's worth.
There she was.
Gone. I think that's a good way to wrap it up. Lots happening in the world right now. And so yeah, we hope that you continue to stick along with the journey here, and we'll try to stay current on all these events and things that are happening in these financial markets, and hopefully give you at least a little bit of guidance or things to think about, so you can sort of plan your own household or business accordingly. And we'll have more updates on the Loonie Hour event in Toronto for December 1st at the Hockey Hall of Fame. We should have tickets most likely going on sale next week with the release of next week's podcast. So we will update you on that. But as always, we appreciate your support. All we ask that you share this episode with at least one friend or family member and leave us a 5-star review. We appreciate that, and we'll see you next week.